Well, good morning. Javinder Rana here. So the topic of the day is reinsurance business. Reinsurance business. So the rudimentary notion of insurance is to enlarge the coverage of risk far and wide for the purpose of compensating economic losses occurred due to peril. Thus, insurance is a mechanism that does not avoid a peril, rather reduces the impact of financial loss on the beneficiary of asset. So, insurance companies are hit by catastrophic risk that may cause bankruptcy to the insurer or owner. Therefore, to negate aggravating losses, primary insurers transfer their risk to reinsurers by ceding a portion of the premium. So in India, places are hit with the floods and droughts due to uneven spread of monsoon. Both events are determined as far-removed catastrophic losses. So tracing the remote past, Enron scam and Harshad Mehta scam, fire in offshore rig of ONGC, PNB scam, and fire in Serum Institute of India are either engineering failure or human failure. The organizations are clipped due to surge in cyber attacks, increasing their data recovery costs, along with enormous property losses resulting due to failure of computer controlled plans. But despite the fact that individuals transfer their risk to the insurers can similarly transfer a part of their risk to some other insurer. Generally, insurers have abundant funds to repay their claims through. So catastrophic events amount to thousands of claims that include extremely huge amount of money. Hence, insurers cede a proportionate amount of risk to other insurers, established as reinsurer for the purpose of the reduction in liability that arises while repaying claims. So they date back to the unfortunate and jinxed evening of 26 November 2008 when terror clouded Mumbai, ensuring the ordeal leading to a massive genocide of human lives. Similarly, on 11th March 2020, the World Health Organization announced the novel of coronavirus as a pandemic. So, pursuant to statistical reports dated 18th August 2020, 21.8 million have been affected by the infectious virus. Many of us perceive the situation as a horror, but few individuals and companies contemplated to support the victims. So these companies are none other than insurers along with their underwriters. However, in India, insurers are permitted to retain only up to a specified limit prescribed by the Insurance Regulatory and Development Authority of India to assure that insurers settles the claims as promised. So, in accordance with the IRDA Reinsurance Regulations 2018, every Indian insurer transacting life insurance business must now maintain at least 25% of the sum at risk for pure protection life insurance business portfolios and 50% for other portfolios. So Section 168 of the Insurance Act 1938 explains the modus operandi of reinsurance as a contract between the insurer and reinsurer, wherein the reinsurer accepts a part of risk of the insurer in lieu of mutually consented premium. So according to Section 101A of the Insurance Act 1938, It is mandatory for an insurance company to reinsure maximum 30% of the sum assured and with another Indian reinsurer. So Section 216B of the Insurance Act 1938 explains the modus operandi of reinsurance as a contract between the insurer and the reinsurer, wherein the reinsurer accepts a part of risk of the insurer in lieu of a mutually consented premium. According to Section 101A of the Insurance Act 1938, it is mandatory for an insurance company to reinsure maximum 30% of sum assured with another Indian reinsurer. So currently there are various reinsurers of voluminous size operating across the world. Amidst dynamic changes in the corporate world, reinsurance companies encounter various challenges in order to sustain their goodwill in the market. So, the evolution of reinsurance in India by endeavoring an overview on the position of reinsurance companies pre-liberalization and post-liberalization is important to understand. The growth and development of reinsurance in India and the Constitution of India divides the power between the central government and the state government and is thus federal in nature per se. So the central government authorized to regulate the insurance sector of India and hence the legal provisions pertaining to insurance industries are uniform throughout the Indian territories. The growth and development of insurance industry has undergone three distinct phases. First is pre-nationalization of the reinsurance industry in India. General insurance companies regulating in India formed India Insurance Corporation in 1956, which started attaining the voluntary quota share cession from various member companies. Subsequently, in 1967, the Government of India made every reinsurer to cede a premium percentage of insurance premium to the Reinsurance Corporation. The authorized Indian reinsurance companies were Indian Guarantee and General Insurance Company and Indian Reinsurance Corporation. Then post-nationalization of the reinsurance industry in India. So in 1972, Government of India established the General Insurance Corporation of India. That was a wholly owned company of the government. GIC enjoys monopoly in the insurance market of India, wherein it wrote a business from 161 countries and was ranked 12th among the best insurance companies. It acquired 60% of the premium from insurance companies of India and the rest 40% from other countries, which resulted in solvency rate of 1.83, which was more than 1.5 as a standardized rate issued by IRDA. Therefore, it was clear that GIC Re alone could sustain huge number of losses along with the setting of claims at the time of a peril. Then post-liberalization of the reinsurance industry in India. So pertaining to the procedure of liberalization of the reinsurance industries, the Indian Regulatory and Development Authority of India, who was authorized to regulate and control the conduct of the entire Indian insurance business, had established 4 subsidiaries named the India Assurance Company Limited, National Insurance Company Limited, United India Insurance Company Limited and Oriental Insurance Company Limited, which were dealing from GIC. Subsequently, private insurance players were permitted to join hands with the domestic insurance players by obtaining legal license from IRDA. Subsequent to the General Insurance Business Nationalization Act 2002 came into force on 21st March 2003, after which GIC supervisory role over the subsidiary companies come to an end. So the subsidiary company's ownership was vested with the Government of India, which made General Insurance Company of India as the only insurance company in the domestic reinsurance market. Then the regulatory mechanism of Indian reinsurers. Section 101A of the Insurance Act 1938 provides that every life insurance business must see 30% of premium amount to the entry, and global insurance business must see 5% of the premium amount charged on a policy. This is also known as obligatory cession. Now it is being divided to 4%. So the IRDAI General Reinsurance Regulation 2000 governed the functioning of the Reinsurance Regulation 3.1 can templates that reinsurance program should abide by the fundamentals and objectives, and these are expand retention limit within India, then simplified business administration, and safeguard the best possible options for the reinsurance amount incurred. Now GIC created a market tourism school on 1st April 2002, where all the insurers for the members of the pool and the members of the pool voluntarily seeded the pool initially. The pool had a capacity to procure rupees 200 crore, which was subsequently revised to 600 crores. So, pursuant to Regulations 310, IRDA General Insurance Regulations 2000, before placing cession outside India, every insurers must offer opportunity to Indian insurers to participate in its facultative treaty. Indian insurance can place business with only those insurers that have a credit rating of BBB. Standard and Poor is giving this rating, or any other equivalent rating benchmark by international rating agencies. So minimum 3 reinsurance branches that have procured a legal license from IRDA and haven't registered under Regulation 4A of the branch office regulations should maintain a minimum retention limit of 50% of the Indian reinsurance business. Then there is a regulatory mechanism of Indian reinsurers, we have seen, and now this continues with the reinsurance market in India. Because the reinsurance industry is a major contributing variable to the economy and has and all of sheer importance of financial markets. But therefore, the prominence of reinsurance industry is sui generis and is enormously an alien catastrophe. It is deemed that the birth of reinsurance took place in 1852 when the first treaty of reinsurance was written by Cologan post a decade of Great Fire of Hamburg. Subsequently, Swiss Re was established in 1863 and Munich Re was established in 1880. Reinsurance is an apparatus where an insurer who bears high volume of risk purchases insurance from other insurers to subsume those risks. The insurer that stipulates reinsurance coverage is called a reinsurer. Similarly, an insurance company that buys reinsurance is known as a ceding insurer, reinsured, or a ceding company. Therefore, one insurance company cedes a proportionate portion of its risk in consideration of a premium amount, for which the ceding company retains the liability to control the subsequent losses. While entering into a contract of reinsurance, insurers agrees to pay proportionate premium to the reinsurance company on behalf of the financial burden imposed to them under a direct insurance policy that the insurer originally issued to its insured. So a reinsurer who procures its own reinsurance is known as a retrocedent. So reinsurance is a channel that reallocates their own risk. Reinsurance primarily is of two kinds: facultative reinsurance and TT reinsurance. So facultative reinsurance, according to Section 2D of the Insurance Regulatory and Development Authority, General Insurance Reinsurance Regulations 2000, facultative reinsurance denotes a certain portion or all of a single policy wherein the insurer and the insurer can separately negotiate on accepting or declining individual submissions. And the treaty reinsurance means, according to Section 2I of the Insurance Regulatory and Development Authority, General Insurance Regulations 2000, treaty reinsurance signifies as a pre-arrangement between the reinsurer and the insurer which provides financial terms along with technical particulars that would be applied to classes of reinsurance business for 1 year or more than a year. So the fundamental difference between facultative reinsurance and the treaty reinsurance is that under facultative reinsurance, the reinsurer has an option to undertake a particular risk and a specific policy. On the other hand, under treaty reinsurance, the reinsurer is obliged to accept the risk mentioned in the contract. So to understand the principles of contractual obligation pertaining to reinsurance, it is necessary to examine the doctrines underpinned in contract of reinsurance. Once there is positive enforcement of the Indian legislature, the language and intention of the legislature would be applicable to the facts of each case. Moreover, the common law of the England relies upon the determination of good conscience, justice, and equity. So these are the good faith, misrepresentation, contract of indemnity. These are the basic things which are applicable to all these reinsurance contracts. Now, insurers transfers the risk to reinsurer. However, on the event of catastrophic event, the burden of reinsurers increases, which would even result in issuing issues pertaining to insolvency. So, contemplating the high or low frequency of catastrophic event, reinsurers must opt for long-term financing techniques to smoothen the future losses. For example, if we overlook the floods that hit Kerala, it was necessary for reinsurance companies to increase their credibility by considering the devices to distribute their risk. So, dissemination of peak risks on capital market or any investor would is the strain implied on capital position of reinsurer that would ascend due to enormous catastrophes. So while analyzing the impact of catastrophic event, it is significant to cognate the severe consequences encountered by the insurance company due to the rollout of the novel coronavirus. The reinsurance sector has ancient acquaintance with the volatile events. It regularly adapts to unforeseen events by developing qualitative and quantitative risk management techniques. COVID-19 has impacted underwriting risk, liquidity risk, reserve risk, asset risk, and operational risk. So, for a few reinsurers, the decline in solvency rate may impact their required minimum capital, whereas some reinsurers will need to overlook the capital models set by the rating agency to avoid a downgrade. Thank you very much.